Today, will the Prime Minister smash and grab your bank deposit? Hello again, it's Martin North from Digital Finance Analytics. Welcome to another post covering finance and property news with a distinctively Australian flavour. And today we're going to talk about the vexed question of bailing in bank deposits. And I'm joined by economist John Adams. Hello, John.
How are you going today?
Very good. Good to see you again.
Excellent.
We had an interesting reaction to our last video, right?
Yeah.
Which was effectively looking at the whole question of Ireland and what happened and therefore what might happen here. And one of the really interesting questions that came up then was, yes, but can't you bail in deposits and other instruments? So today we're going to explore that a bit further.
Yes. We left the last episode asking viewers what would they want for Australia if the foreign creditors wanted their money back. And we basically presented two options to the viewers on that occasion and said that either you say no to the foreign creditors and the banks fail and we have a depression like 1892, or we have a bailout, the government paying the money effectively to the foreign creditors. I was surprised with how uniform the response by the DFA sort of viewers and subscribers were. I would say about 96% of people who responded in the comments said take the depression. But there was a couple of comments that said, can't we bail in deposits to keep the banks alive? Now, so that's obviously what we're going to talk about today. So I think the key point there is that when it comes to bank deposits, the government's public position is bank deposits in this country are safe. It cannot be bailed in. And we're going to explore some of the legal and political ramifications in terms of that detail. We think there's bail-ins potentially could occur. And we'll explore why we think that is a possibility.
And it's worth saying, I think, that this bail-in conversation is actually much more complicated than people might first think. So we are going to have to get into a little bit of detail today.
Yeah.
But there's also one or two case studies that we can look at in terms of other countries where they've declared what they're going to do, or indeed some where they've actually executed it already. So let's start right at the beginning then with what do we mean by bail-in the first place?
So I think where we should first start is just going back to the basic accounting question: assets minus liabilities equals owner's equity. So in the context of a bank, what is the bank's assets? It's basically either its loans that is issued to customers or the investments that it holds, and that could be investments in shares, bonds, real estate, options or derivatives. The liabilities of the bank is what does the bank owe, the deposits or any other financial products, say hybrid securities or convertible notes, where banks customers have either put money in the bank or have invested money with the bank. That is what the bank owes the customer. And then obviously the difference between those is basically the capital reserves or what is left over for in terms of the capital structure of the bank.
And just to underscore that, the liabilities side of the ledger, right, is customer deposits, plus the bonds and other instruments that the banks have actually lent out to other people and effectively got funding from them.
Yes.
But they have a liability to repay those bonds somewhere down the track, right?
Precisely.
Yeah. And so that's really important that people understand that the asset side of the ledger, which is the loans, is offset by the liability side of the ledger.
Yes.
And the gap between the assets and liabilities, as you say, is effectively the shareholders' equity. And in Australia, that equity amount is only about 5% of the total. So the banks are very leveraged up here.
So basically, once you have a financial crisis, that is when the people who have borrowed the money from the bank cannot pay, i.e. a default, or if the bank has made a bad investment, i.e. derivatives, they incur a loss. So what happens then is you get a loss, like a reduction in the value of the assets of the bank. And basically for that basic accounting equation to remain equal, you basically have to reduce your liabilities or you have to increase your owner's equity to offset the fall in the value of the assets. From that basic premise, you basically have a couple of options as to how do you meet that basic accounting equation. So first one is if you do not want to rescue the bank goes into insolvency, bankruptcy. Whatever assets can be sort of salvaged are basically then sold off to other parties. Option two is is where you get a bailout, and you basically get an injection of new capital. So in order for the equation to balance, you get basically new owner's equity, and typically that's what has happened 10 years ago in the GFC. That was governments injecting bailout money into the banks to give more capital to offset the fall in the assets. Or the third option is the ability to convert liabilities into owner's equity. Before the GFC, there was an element of these, what they call hybrid securities, and we'll talk a little bit later about what those are, that they could be converted from a liability into owner's equity, into shares. But obviously, since the GFC, there's been a greater attempt to make more liabilities in the bank's capital structure to be convertible into owner's equity, so that there is, one, less risk of banks going bankrupt, and two, there is less risk of governments being required at the taxpayer's expense to bail out the banks.
Really what happened post the GFC was there was such a shock around the world as governments effectively had to throw in vast amounts of money to rescue banks in the US or in the UK or Ireland, as we discussed recently. And so there was very much a strong intent from, if you like, the central bankers' bankers to say, we don't want to go there again, right? And so post the GFC, there was some new thinking and new doctrines which were propagated effectively, saying there's got to be an alternative way. And that's where the bail-in thing comes in, which, as you say, converts effectively one set of liabilities into another type of liabilities and effectively can bolster equity in the bank effectively, which means that the bank can continue to trade, so it doesn't fall over.
Yes.
Right? And in fact, the Financial Stability Board was the entity who was starting to drive this, right? Which is effectively the global controlling entity in terms of thinking about some of the broader risk issues inside the system.
Yes, where some of the major thinking and the driving force was actually the G20. And if you recall, Kevin Rudd was instrumental in instituting the G20 after the GFC. So before the GFC, it was the G7, and then I think if the reports are correct, Rudd got onto the phone during the crisis to George W. Bush and suggested about instituting, in terms of G20. Obama came in and basically they came up with the G20, and the G20 delegated this question to the FSB, and they created the FSB. So it's slightly separate from the BIS, but it is still the same type of people thinking about these questions.
Yeah, and the thing to point out there, then, it's both a political intent,
yes,
and also a central banker's intent, right?
Indeed.
And the G20 effectively is where it coalesced initially, and then it was delegated down to the FSB to work out what to do.
Australia, as part of the G20, since the GFC, has signed onto certain statements and communiques that, to be honest, have virtually got no press in Australia. And I think most Australians are quite ignorant as to what has their government signed their people up to. Some of this has to do with bail-in. So there's been a couple of statements where the Australian government at the time, whether it was Labor or coalition basis, says, yes, we are going to subscribe to this international framework of bail-in. And yet the media didn't tell the people, and the government, actually more importantly, didn't tell the people that, this is our intent to actually sign up to these statements. So let's go to statement one. So this is from the G20 in Seoul in South Korea.
G20 Seoul Summit Document, paragraph 30. We reaffirmed our view that no firm should be too big or too complicated to fail, and that taxpayers should not bear the costs of resolution. We endorse the policy framework, work processes and timelines proposed by the FSB to reduce the moral hazard risks posed by systemically important financial institutions and address the too big to fail problem.
So this was the statement in 2010, basically saying we're not going to go back to this bailout sort of scenario that we had 10 years ago, so we need to find a new solution. So the G20 said, let's find a solution. And after 2010, the FSB, but also a whole host of other players around the world started to look at this question. And I think from memory, APRA put out a discussion paper in 2012 looking at potential options as to what is Australia's thinking on this particular question. And so then we got, so obviously 2012, the Greek sovereign crisis happened, sovereign debt crisis happened. Then within Cyprus did a bail-in of uninsured deposits.
You can have the money, but you've got to pay for it. That's German Chancellor Angela Merkel's message to Cyprus, where panicked savers are withdrawing cash from their accounts. The Eurogroup and the International Monetary Fund have agreed a €10 billion rescue package for Cyprus, which is teetering on the edge of bankruptcy. But a condition of the bailout is a one-off levy on bank deposits to raise €6 billion. At the helm of the EU's largest economy, Merkel says the radical measure makes sense. So we said, people who have their money in Cyprus's banks have to contribute to saving Cyprus. So everyone who has more than €100,000 in his or her account will be taxed by almost 10%. In so doing, the people responsible will contribute, not only taxpayers from other countries, and that is correct in my opinion. There will also be a tax of 6.75% on smaller deposits. To go through, the aid deal still has to be approved by parliaments in several Eurozone nations, including Cyprus.
Above €100,000, they took 47.5%. But that was a bit of an isolated incident, and that was a successful bail-in, but we haven't seen that version play out yet. So the G20 met in Brisbane in 2014, where they came to consider the final proposals from the FSB on terms of this question, and basically the leaders' communique from the G20, which Tony Abbott was Prime Minister, so he was the one who signed off on this, said the following.
G20 Brisbane 2014, Leaders' Communique, paragraph 12. We welcome the Financial Stability Board FSB proposal as set out in the annex, requiring global systemically important banks to hold additional loss-absorbing capacity that would further protect taxpayers if these banks fail.
So this was the statement that they endorsed. So there was the FSB set out a range of principles in 2014. The G20 said we endorse these principles, and then they went off to make these principles live in their own countries. When the Australian government signs onto these international statements, they don't actually have any legal force unless if it's actually implemented in domestic law. I think the question should be asked is, what was the intent of the bail-in? What were they trying to bail in? And Glenn Stevens in 2014 made a very interesting statement on that.
RBA Governor Glenn Stevens, June 2014, speech, Financial Regulation, some observations. It is argued that further loss-absorbing capacity is needed to be called on at the point of non-viability, so as to allow vital functions to continue and non-critical operations to be wound down in a controlled way. This limits adverse spillovers to the system and the economy. Generally, this loss-absorbing capacity is to come from a bail-in of certain classes of private creditors, so as to avoid calling on the public purse for a bail-out.
So obviously, here's the former governor of the Reserve Bank saying that basically the RBA, the government, has signed on to a bail-in framework. But the thing here is obviously, what is the intent of the bail-in? Now, what the G20 was saying publicly and what the government has been saying publicly since 2014 is what they want to bail in is basically hybrid securities. So hybrid securities are basically financial products that offer an attractive yield, generally above market rates. That could be like a bond or a convertible note. You send your money to a bank, they basically pay you interest, and then at the end of the term of the product, they give you your capital back. Now, one point to make on this is that I think for a lot of DFA viewers is if you've got a wealth manager or a financial advisor who you are using, I think there's quite a few financial advisors who have been putting client money in these hybrid securities, and I think a lot of customers are not particularly aware as to what are the risks involved in terms of these products.
It's worth saying just a couple of things on those hybrid securities. Firstly, there was quite a big splurge of them being sold, 5 or 6 years after this all came out, right? And in fact, some of them were sold probably to people who didn't know what they were getting. And in fact, ASIC subsequently put out a warning and reminded the banks that, one, they had to be disclosing all the risks in these hybrid securities, and two, they were only available to sophisticated investors. They weren't available to mum and dad investors. But your point is dead right. It's not clear to me whether, in fact, all holders of hybrid bonds actually understand really the risks that are involved, because there's a trigger point, right, which basically says that at some point, in some circumstances, that bond gets converted from paying quite a high coupon, on an ongoing basis, to shareholder equity.
Yeah.
And at that point, you no longer get the returns on the bond, and there is no guarantee that you actually have any equity there, because, of course, the equity will be offset against the assets or the value of those assets. So it becomes then a risk instrument rather than actually just a coupon paying instrument. And that's the point that people may not have understood.
Yes. So it does become a risk instrument. But I think the other point is that if it is converted to owner's equity, just like with the Bank of Cyprus, what is the value of the share? Particularly if you've got a distressed bank. Basically, what the banks had to, in terms of their capital structure, in terms of their owner's equity, it was bank reserves. There was a little bit of hybrid securities were in play before 2008, but it was a very minor aspect, and there was not a lot of money in that. So basically, you had a certain proportion of money that was there to keep the banks afloat, and they call this the capital structure, which is basically it is made up of common equity and what they call additional tier 1, additional tier 2. So obviously post GFC and where we are today is we've got bank reserves, we've got hybrid securities, and the hybrid securities is obviously much more pervasive throughout the financial market. So we're talking about 100 billion. And then you've got this committed liquidity facility, which is effectively a promise from the Reserve Bank that if banks become distressed, they will buy mortgage-backed securities from the banks, like at a particular price, give the banks cash, and that cash will be then used to prop up owner's equity so that it can offset any fall in value of bank assets.
It's worth saying that not all banks can access that CLF. It's 15 of the largest, right? So effectively, they have that advantage of the guarantee from the Reserve Bank if things go wrong. Now, they have to pay a small premium for that in terms of access to the facility, but that means there's not a level playing field between those banks and the rest of the banks. So let's just recap then, John, just so we're clear. Essentially, we had a situation where this whole concept of bail-in was introduced as a way to stop public money having to go to bail out banks. Okay? Yes. Through the early 2010, 15 onwards, this new structure was actually developed. And by the way, it includes things like living wills for banks so that people actually have an exit strategy as to how to deal with a bank if it falls over. But the bail-in thing is the critical leverage point. Yes. But that has to be made into legislation locally to have any effect. That's taken quite a long time, but in early 2018, legislation was passed in Australia, and there's a story around that legislation, isn't there?
In February of 2018, the Financial Sector Legislation Amendment Crisis Resolution Powers and Other Measures Act 2018 was passed by both houses of Parliament. I think just on the politics, it basically went through on the voices. So this was, what that means in parliamentary terms is it was uncontested. So basically, no one spoke against the bill, and because when you get legislation that no one opposes, it basically just sails through on the voices, and there's no formal vote. So there's no formal vote in the House, and there was no formal vote in the Senate. Now, I have spoken to certain members of Parliament about this particular piece of legislation, and they had no idea that the legislation was ever on the books or that it ever went through Parliament. So from my experiences, having worked in opposition, is the minister or the shadow minister is responsible, particularly for the major parties, is responsible for the legislation. They go to cabinet or shadow cabinet and basically get endorsement on the legislation as to what their view is. Then they go to the respective party rooms and basically put it to them and basically say, cabinet has said we want this, particularly in the coalition sort of context, and then the party room will basically endorse it. So that is the process of how you get parliamentary consensus that's not in the chamber. But obviously, when it comes to the chamber, if there is no controversy about the legislation, then there is no vote. It's just basically passed. But I mean, you get the speaker saying, "Do I have a seconder?" All those in favour of aye say yes. Those opposed no. I think the ayes have it, and then it basically just goes through. And that's what. That when they say it's passed on the voices, that's exactly what happened in the House, happened in the Senate. So clearly, members of Parliament had, particularly in the major parties, the minister and the shadow minister would have went to cabinet, shadow cabinet, and presented a position on this legislation, and then they would have taken it for the coalition. They took it to their party room, joint party room, and then obviously for Labor they took it to caucus, and then the backbench had an opportunity within their own party room to debate and to come to a position. And they all said, no problem. But having said that, because parliamentarians are busy, and to be honest, most parliamentarians don't read the laws they pass. So certain politicians, when I've asked them, didn't really understand that this was on the books, that it had been passed. And once I've tried to explain to some of these politicians about what Parliament actually did pass, they've been, one, surprised, and two, quite concerned, knowing what the state of the law is. So where the controversy comes in with this particular legislation, so obviously we've had the Citizens Electoral Council, so Robbie Barwick, who you've interviewed previously, he has said that this legislation now opens the door for a bail-in in terms of uninsured deposits, whereas because there was a Senate Economic Committee inquiry into the legislation, and they said no, the intent is to give APRA the legal power to bail in hybrid securities, consistent with what Australia has said at the G20, consistent with what Glenn Stevens said in 2014, and what the public position has been all along. Now, the controversy comes up with Section 31 of the Act. And Section 31 basically defines, so bail-in this legislation in the parlance is conversion and write-off provisions. So conversion as in you can basically either convert from a liability into owner's equity, i.e. a bond into shares, or write-off. So you can write off certain liabilities of the bank. So the definition is conversion and write-off provisions means the provisions of the prudential standards that relate to the conversion or writing off of additional Tier 1 and Tier 2 capital or any other instrument. This other instrument is basically where the linchpin is. Now, the government has, and Treasury and APRA has said, any other instrument means that anything that's not in Tier 1 or Tier 2 that is of a capital nature that basically can be converted from a liability into owner's equity that's not in the current framework will be included in this particular clause.
Just so to be clear, it's a catch-all phrase, isn't it? That's the whole point about it, because they couldn't predefine the other types of capital instruments that may or may not be developed down the track.
Yes.
So what they were intending to do was to keep the door open as wide as they could,
yes,
to deal with any new capital instruments that might be created. However, the problem is that there could be another interpretation of any other instrument, and this is what some people are saying, is does it leave the door open to deposits also being caught within that same ambit, right?
Yes.
And the interesting thing about that was, as that bill was being passed in the Senate, and it was late in the evening, there were 7 people in the chamber, there was an attempt by one of the minor parties to try and put an amendment into this bill before it was actually passed to specifically exclude deposits. And that amendment was lost. Right? So that's the history. So we've got this any other instrument thing, and there's some question marks about what precisely any other instrument may or may not mean.
The amendment was never offered on the floor of the Senate. So basically, a minor party went to the finance minister because he had carriage of the bill in the Senate. There was a commitment that the government would look more closely at that amendment. But while the minor party thought that the government was seriously looking at the amendment, the government and the opposition, secretly passed the legislation in. Now, people may find that language surprising, but when I say secretly, as in 7 people were in the Senate, they passed the legislation on the voices, no one spoke against that. The minor party, had they known the government wasn't going to seriously look at their amendment, may have gone into the Senate and tried to oppose the legislation or try to push the amendment on the floor, but none of that occurred because they thought the government in good faith was trying to look at this amendment, and that didn't basically happen. But obviously, just going back to what the government, the Reserve Bank, Treasury and APRA has said publicly. So there's a couple of statements from the Senate Economics Committee report that I think is important because what we're getting down to is this any other instrument. There's an understanding of what a capital instrument is, and there's an understanding of what a financial instrument is, and one excludes deposits and one includes deposits. So when the Senate Economics Committee said that in relation to a capital instrument, is a capital instrument is a form of financial security, for example, a share, note, or bond. Capital instruments are categorized based on the level of risk that they carry. Through the implementation of the Basel III capital framework, APRA's prudential standards require that capital instruments characterized as common equity Tier 1, additional Tier 1, and Tier 2 include certain conversion and write-off terms. Importantly, the terms of additional Tier 1 and Tier 2 instruments must provide that they absorb losses in the event that an ADI or insurer is in distress. So clearly, what the Senate, what the committee understood, and obviously they wrote in the report, is any other instruments is a capital instrument, and the capital instrument that can be converted has to have clear terms and conditions up front to say that you can convert. So I think the government and the regulators and the RBA and the Treasury put a public position forward, and the senators, particularly I would say Senator Whish-Wilson, because Senator Whish-Wilson went onto the floor during the debate on this particular legislation, and he said, I accept what APRA has told me, that any other instruments does not include deposits. So this is why the Greens implicitly went with what the explanation is. And obviously this language from the Senate Economics Committee report basically confirms that position. Now, on the issue of financial instruments, financial instruments in accounting terms mean something else. So when you prepare financial statements, and you're defining a financial instrument, it has a particular definition. And the Reserve Bank in their own annual report, when they've put together their own financial statements, they have referred to financial instruments on the RBA's balance sheet. So the definition of a financial instrument, according to the RBA, with their own financial statements, is a financial instrument is defined as any contract that gives rise to both a financial asset of one entity and a financial liability or equity instrument of another entity. The identifiable financial instruments for the RBA are its Australian dollar securities, its foreign government securities, bank deposits, interest rate futures, foreign currency swaps, gold loans, notes on issue, and deposit liabilities. So clearly, when you're looking at any other instruments from a pure accounting international financial reporting standard framework, which is what the Reserve Bank uses to prepare its financial statements, a financial instrument includes deposits, and yet when APRA talks about instruments, it's talking about capital instruments, and it doesn't include deposits. So obviously, because now the other thing we should say is that nowhere in the legislation have they defined a capital instrument. They haven't defined instrument. And this legislation, what the effect of it was to amend the Banking Act. So I went into the Banking Act and looking for a definition of instrument or capital instrument, and there is basically no definition. Where we are now is that the position is ambiguous as to, does any other instrument mean financial instrument or capital instrument? And in a crisis, even though the government has assured senators, but also members of the public, that deposits are not on the table, can the interpretation of this language and the other instrument change when you're looking at one of the big four banks potentially going under?
And I'll just give you a bit of information which I haven't shared with you before, John, but I've had a few people over the last 4 or 5 months send me emails on this very subject. And they've attached various pieces of correspondence from their MPs or their MP's office, right? And it's really interesting. I'm not going to go into chapter and verse on who said what, but some MPs have written back to individual people who've asked this question and said, no, deposits are definitely not included. But other people have said deposits are included. So even amongst MPs, I don't think there's any clarity on what's in and what's out.
The legal position is basically unclear because the government won't define precisely what other instrument means. It could mean one of two things, but also they haven't actually put in any exclusions in the legislation around deposits. So that's obviously one. Now, so that's point number one. The other points is obviously Cyprus. Because we know what happened in Cyprus, that's causing a lot of doubt amongst not only Australians but citizens around the world to say, well, if the Cyprians did it, why can't other people do it? And then obviously the third element is New Zealand and the European Union have explicitly said that in their bail-in frameworks, deposits are included.
Yeah, and the EU is really interesting, but I think New Zealand is the really most interesting one, right? Because one, it's very close to us, and two, they're absolutely explicit in their particular construct around bail-in, that in New Zealand, deposits are included in the bail-in process. And they've put up quite a nice chart which actually shows the journey. So a bank gets into difficulty, effectively the Reserve Bank in New Zealand can grab deposits to help restructure the bank, to manage it through. At the end of the process, they give some of the deposits back to the depositors and the bank carries on. That's absolutely clear, crystal clear, and there is no ambiguity in the New Zealand legislation.
Look, in terms of the viewers, I mean, if they want to know more about the New Zealand or the European Union sort of policy, so the name of the European Union policy is the Bank Recovery and Resolution Directive, and in New Zealand it is the Open Bank Resolution Policy. And in the European Union example, uninsured deposits above £100,000 are basically on the table. Whereas in New Zealand, there is no caveat. Basically, everything's on the table. Now, one important thing to note is that in Australia, APRA has a dual responsibility for promoting financial stability, but also to protect depositors. Whereas the New Zealand Central Bank does not have any obligation to look after depositors. So they only have one obligation, which is to promote financial stability. And basically, if you want to say that New Zealand has a more neoliberal philosophy compared to Australia, I mean, that potentially could be fair to say. But in New Zealand, the premise is that you, the depositor, ultimately, it is your money. You have to determine what is the best place to put that money. You have to determine the risk of where you put your money, and you will ultimately wear the consequences of where that money will be. Whereas if you want to sort of say this, the Whitlam government introduced the Trade Practices Act, and since the mid-70s, there has been a strong emphasis in Australia around protecting consumers, consumer protection. So I think this protecting depositors in the APRA legislation is probably from that philosophy of consumer protection.
And I think it's just worth highlighting, right? 2 points. The first is, just replay what you said. If you are a depositor in New Zealand and you want to actually figure out where to put your money, you as the depositor has to figure out where the risk is lower or higher amongst all the various banks who you could put money with. I have no idea how anybody can do that, but that's the obligation that the New Zealand Reserve Bank has put on depositors in New Zealand.
Yes,
right?
yes.
Which is remarkable. Now, in Australia, I agree with you that effectively APRA has responsibility for depositors as well as financial stability. But there's an interesting debate, which is depositors and deposits the same? Or could you actually argue that you protect depositors by effectively keeping the bank alive, and therefore by grabbing deposits and are using those to restructure a bank so that it doesn't fall over, you are actually indirectly protecting depositors? In which case, you could argue that depositors are being protected, but deposits aren't being protected. Now, that could be angels on the head of a pin, but I think it's quite an important issue.
So I would agree with you that in that instance, I mean, so if I was the bank or if I was APRA and I came to you, Martin, and I said, well, you can either lose all of your deposit, or if you're willing to take a 20% haircut, I'll give you 80%. Well, you know, in that situation, you could say APRA is protecting the depositor by protecting as much capital as APRA can, compared to the counterfactual, which is the depositor has to lose everything. So I agree there is a distinction in the law between depositors, which APRA is required to protect, versus deposits. Although the other interesting thing that I think is unclear in the legislation to my mind is that the legislation says that it's a dual obligation. So one doesn't have, you know, this priority over another. But what happens when the two aspects come into conflict? When you have a choice between protecting depositors versus financial stability, which one takes precedence?
Well, of course, APRA tends to veer towards financial stability. I'd make the point. But who knows? I mean, this is uncharted territory, isn't it? Because, of course, it's all theoretical. It's never happened, right?
Yes.
And that's the point. The other point it's worth making, I think, that when Wayne Byers talks about this, right, and he's actually given several statements in various committees, he's always made the point about depositors, right? I can't find anywhere where he has expressly said deposits.
Yeah.
And I think that's relevant and significant.
The FCS will be activated by the Australian Government when an institution fails, and once activated, will be administered by APRA. The question, which many voters are very worried about, is, and I am anxious to have verified by APRA, is: are bank deposits currently protected by the FCS? That is the financial claim scheme currently activated?
Sorry, is it currently
activated?
Well, it's not currently activated in the sense that it's only activated when a bank fails. But if it is activated, so if a bank fails and the government activates the scheme, then depositors in ADIs up to the amount of $250,000 are protected.
So it is. So basically,
so
then
the
you're saying
legislation is there. It's available.
Activated.
If the circumstances arise that a bank fails, the mechanisms are there for it to work. The government, in a sense, switches it on, and we go through the process then of making sure that depositors, as I said, up to the limit of $250,000 per ADI, get their money.
You're protecting it.
APRA has
The bank accounts are protected.
a lot of work over the last couple of years around implementation of the financial claim scheme, working with industry to put in place prudential standards around reporting and reporting to us and reporting to the Reserve Bank on the amounts that are protected, and also running trial runs of the provision of information to the Reserve Bank to test that when the FCS is activated, that banks will be able to actually, and APRA and the RBA will actually be able to effectively get money to depositors within the timeframes that are specified.
And just as a follow-up, sorry, Senator Hanson, you're absolutely right. There was some considerable concern from a particular group called the Citizens Electoral Council, who actually are a political party. But I understand that APRA submitted to that inquiry, that particular legislation inquiry, and testified to that extent. And so did the RBA, and so did ASIC, and they said that those powers are not at all a threat to depositors' funds.
As I said in my opening statement, our core purpose set out in the Banking Act is protect depositors. And the FCS is there to make sure that particularly retail depositors, but depositors with amounts up to $250,000 are not at risk of losing their money should a bank fail.
So that's guaranteed by the government. It's definitely there, so there's no problems with that guarantee.
That's right. The way it works is that if needed, there's an appropriation that exists that can be drawn on to give depositors their money, and then there's a mechanism by which that cost is spread over the rest of the industry and recouped from the rest of the ADI sector. So it's not a cost to the taxpayer, and it's certainly there to protect the depositors.
Going back to the title of this episode, which is about the Prime Minister. Now, look, so for the viewers, I came up with the title. Now, the reason why I thought it'd be good to talk about the Prime Minister is that so let's just go. So we've got a diagram up on the screen to talk about how does a bail-in actually work. So Section 13E of the Banking Act basically has the law about how does APRA issue a recapitalisation directive. So if a bank is in trouble and then you need new capital, APRA can order the bank to recapitalise, and APRA can basically dictate the terms of how that would happen. So for example, if there needs to be a bail-in on hybrid securities, you would expect that in this recapitalisation directive, APRA would be able to state that. Now, if in a crisis they said, well, we need to bail in deposits. Now, going back to hybrid securities, only about 100 billion. Deposits is probably about 1.1 trillion. So there's obviously a bigger pool of capital to pull from. So how it would happen is that APRA would be issuing a recapitalisation directive to the banks, and basically in that directive, it would then be saying certain things. I mean, so if this were to happen, it would say take deposits or take certain deposits, because we've got deposits insured up to 250,000. So it could well be if you've got deposits over 250,000, take a certain percentage of that. Now,
well, hang on. Let me just touch on that because it's really important. That 250,000 is a guarantee that is on the statute, but is not active at the moment.
yes,
It needs to be activated by the government, right? And what that says is that there's an interesting hierarchy of actions, right? So would APRA trigger a bail-in before or after the government triggered the 250k? Because until it's triggered, that guarantee is only written in the statute. It doesn't exist.
Indeed. But the point to note there is that because of the way the law is written, when APRA does issue this capitalisation directive, the duty of APRA in issuing the directive to the bank is that it is protecting depositors, but also promoting financial stability. So Section 12 basically says that for this Division 2, everything under Division 2, you have to be looking at both lenses, depositors and financial stability, and these recapitalisation directions are basically part of that Division 2. So when the bailout instruction comes in, or the bail-in instruction comes in, that has to be paramount in the instructions that APRA gives. Now, so the question then becomes is, the law is ambiguous. APRA under the law has the power to issue a directive to a bank to bail in. What they bail in is obviously, I think will be a function of how much financial trouble the banks are in. But in my mind, knowing how politics works, I can't see it conceivable that APRA would actually go alone and issue a bail-in of deposits independent of the Treasurer, independent of the Prime Minister, independent of Cabinet. So I think we have the Financial Council of Regulators.
The Council of Financial Regulators, and that includes APRA and ASIC and the Treasury.
Yes.
Right?
Yes.
And the RBA. It's actually chaired by the RBA.
Yes.
And in fact, if you think about it, they are the four entities that basically together make the calls on all of this stuff. So you'd expect them to be involved, but I suspect you're right. Then it would be taken to ultimately the Prime Minister and the Cabinet. Say this is what we recommend.
Yeah. So I think that is effectively correct. That at the end of the day, if there is a bail-in, would you be able to imagine that APRA goes it alone, and then the Prime Minister is in front of the cameras the following day and saying, I didn't want this to happen, but APRA has the power, and it basically, like Pontius Pilate, I've got to wash my hands of this, but basically, the independent regulator did what they thought they had to do. I just don't think that the Australian people would buy a Prime Minister saying, we took your deposits, but I didn't want it to happen, but I had no control over it. So I think at the end of the day, because if I was PM and APRA did this, knowing that I didn't want it to happen, well, what would I do the next day? I would sack the head of APRA, and I would probably sack, maybe the head of some of these other agencies, and saying, well, how could you implement this sort of action with the political ramifications on the table, and you didn't get the endorsement of me as Prime Minister and the Cabinet? So I think at the end of the day, the government has said deposits are not on the table. The law is unclear. But if in a crisis, if the phone call comes and the Prime Minister says, if the foreign creditors say, we want our money, Prime Minister, we don't care how you get it, but give us the money, prop up these banks so we get our money. Well, then the Prime Minister may say, well, a bailout, maybe I have to go to Parliament to get a new appropriation bill, and then that could be problematic on the floor of Parliament. But I can I can sort of action this bail-in process, and we can take depositors' money to give to you, as in the foreign creditors. So that is the third option to avoid a depression. So legally possible, but ultimately will have to be given political sign-off, in my view.
So, John, we've talked then about how bail-in might work, right, and what the consequences might be. But I think it's worth just standing back and thinking about what are the implications if, in fact, bail-in is triggered.
So I think there's a short-term consequence and there's a long-term consequence. So I think the short-term consequence is if you bail in deposits to keep the banks alive, what you're going to do is you're going to keep the system going, so you don't have a systemic failure, you don't have a depression. So that gives the people and the government time to restructure the economy in a more considered way, without any crisis and having to panic and making some rash decisions. But the question then becomes is, if you bail in and you keep the banks alive and things continue, what do you do in that period afterwards? If you take that opportunity to engage in structural reform, well, then a bail-in could be, like a bail-in for, obviously a bail-in for those who have lost their money is going to be a bad thing, but for society as a whole, a bail-in when you're going to do structural reform afterwards, I think that could potentially be a good thing for the economy. If you bail in but you do nothing with the structural problems that are currently present in the economy, I think that's a wasted opportunity, and you're going to be effectively kicking the can down the road, and you're going to be having to face some sort of issue at some track down the road. But then I think the more important issue is that what is it going to do to confidence and trust? Because I think for DFA viewers, what they need to realise is banking at the end of the day is trust between the banks who take the money and the depositors who give the money. And basically, once that trust has been fractured, you're going to fracture that for probably about 20 or 30 years. So there are all sorts of stories about Australians in the 40s, 50s and 60s and 70s having a deep mistrust of the banks. I mean, a couple of months ago, I spoke to a real estate agent here in the Illawarra, and he was telling me about someone who he worked with a particular family, sold some property for them, and basically back in the 70s they ran a steel manufacturing business here in Wollongong, and they never, with all the company proceeds, they never put it in a bank. They actually had their own personal safe, and basically all the proceeds of the company, and it was a relatively large, successful manufacturing company, that we're talking millions of dollars. It was all stored privately, basically in their own vault. It was some cash, some gold, silver, all of this sort of stuff. But they basically said that they couldn't trust the banks after the Great Depression. And basically they didn't do their banking there. So when this real estate agent told me this story, I just found it sort of surprising. How can a business that is doing domestic and international orders not use the banking system? And he basically said, the explanation to me was, it's old school. It was the way business was done. So this is a clear example of, if you break that trust, it's going to have generational impacts about how citizens interact with the banking system and how economics and commerce is done moving forward.
And I think it's just worth thinking about this, because I think all of these bail-in sort of constructs was really designed for a single bank going wrong, right? And effectively solving that problem. But imagine if we've got one of those severe crises that we've discussed previously, where you've effectively got, multiple banks all failing at the same time, and effectively, the financial crisis, a bit like 10 years ago, is there. You can see just how complex and difficult this becomes and how politicized this decision actually is. So I actually agree with you that this is not going to be something that's done in the back room at APRA. This is definitely going to be centre of mind in the political environment. I think the other point that's worth making is people perhaps will get concerned about hearing about this, right? Because effectively I've already had a lot of people on the YouTube channel and on my other channels saying, are deposits safe, right? And I think my conclusion from all of this is, well, probably they are, but there's absolutely no guarantee because the legislation is fuzzy, right? Yeah. The processes are unclear. Mm-hmm. And the political overlay that we've touched on towards the end of this show highlights just how politicised this whole thing actually is. So, to my mind, we should be pressing the politicians here to come clean on, one, what was their intent, right? And two, I think there should be more information about the processes that would be invoked and how it would work, so that the public actually understand more about this very important issue.
If the government may say there is nothing here to see, so their public position is their public position. But then obviously the argument is, well, why can't you make it like crystal clear in the legislation just so there is no doubt?
And I come back to that point. If they'd only put that clause in about excluding deposits, all of this would have gone away. But you have to ask the question, why didn't they?
That is probably a mystery for Colombo.
Okay, we'll phone up and try and get the answer. John, thank you very much. Very interesting discussion today. And I think that this is going to run and run, as they say.
Yep. Thank you.
So there you have it. Bail-in is not clear-cut. And hopefully we've answered a few of the questions that you've asked. But frankly, we can't give you a definitive answer at this stage because nobody knows. If you found this useful, please do like the post and add a comment or question. I do read them all. And if you haven't subscribed, please do so. And by the way, if you like what you've seen here today, please support us via our Patreon program. I'm Martin North from Digital Finance Analytics. Thanks for watching, and I'll talk to you again next time.